Yeah, and, right off the bat, the material maps out some incredibly precise support zones and stochastic RSI levels, but there is an immediate opportunity to elevate this raw data into a true strategic roadmap.
Let's jump right into the section discussing the script-wise technicals, because I think there's a lot to unpack there.
Absolutely. The analysis accurately isolates technical indicators across various scripts, but frequently stops short of synthesizing what these extreme metrics mean for immediate portfolio strategy.
Right, I noticed that too. So what is the core weakness you were seeing with how they presented that?
Well, the structural gap here is that the document essentially hands the reader a list of mathematical realities. It tells them precisely what is happening, but it completely leaves out the crucial "so what" for a trader who is actually deploying capital.
I mean, that makes sense. Can you give me a specific example of this from the text?
Yeah, look at how Lucky Cement, or LUC, is handled. The text notes it has hit an absolute floor stochastic RSI of zero point 0.00, just sitting right on a 449.89 support level.
Oh, wow. A 0.00 reading.
Right, exactly. And then over on the other side of the spectrum, they mention Gondara Automobiles, GAL, which is sitting heavily overbought with a stochastic RSI of 100.00 at a price of 633.39.
Okay, yeah. So they have the extremes mapped out perfectly.
They do, but presenting these figures in isolation turns the document into a data dump rather than an actionable trading thesis. The reader is left doing the heavy lifting of translating a zero point 0.00 oscillator reading into an actual concrete position.
It is like reading a car speedometer with extreme precision without mentioning if the car is heading toward a cliff or an open highway.
That is exactly it.
I mean, you are going exactly 85 miles per hour, but you have zero context for the terrain ahead. So what is the suggestion here to fix this?
The author needs to actively integrate immediate strategic implications, things like risk-reward ratios, or conditional logic based directly on these extreme readings.
Elevating it from a mere observation to a strategy?
Exactly. An oscillator at zero isn't just a fun fact. It is a mechanical condition representing maximum momentum drain relative to a specific look-back period.
Right.
So, for luck, instead of just stating it is at a maximum oversold level on the lower boundary of an ascending channel, they need to frame this setup as a highly asymmetrical risk-reward opportunity.
Meaning the author should define the specific downside risk for the trader reading this, right?
Yes, explicitly state that this condition requires a tight stop-loss placed just below that 449.89 horizontal support. That defines the exact risk parameter for the reader.
Because if that support breaks while momentum is literally at zero.
The bottom falls out. Exactly. You transition the text from an observation to a strategy.
And what about the gal example?
Well, for Gandhara Automobiles, the author needs to define whether that extreme 100.00 upward momentum dictates a hold and trail stop scenario to capture further algorithmic upside, or if it serves as a strict take-profit warning before an impending mean reversion.
I want to challenge this purely mechanical view, though.
Okay, sure.
If we are asking the author to provide the so what, shouldn't they also provide the historical what happened last time?
Mm-hmm.
I'm looking at these 0.00 and 100.00 extremes, and I wonder if this section is missing historical context. Could adding historical context of how these specific scripts previously reacted at 0.00 or 100.00 Stoch RSI strengthen this section even further?
You know, introducing historical performance is a bit of a balancing act.
How so?
If you dump 10 years of backtesting into a daily analysis report, you clutter the immediate tactical view. The reader loses the thread of the current session entirely.
Right, that makes sense.
But a brief, highly targeted reference anchors the logic perfectly. If the author writes that the last 3 times luck hit a 0.00 stochastic RSI at this specific channel support, it resulted in an 8% bounce within 2 sessions.
Now you are no longer just citing a trailing indicator. You are citing a statistical probability.
Exactly. And it forces the author to think about the underlying mechanics of the trade. Like, why does it bounce there?
Because institutional algorithms are programmed to recognize that exact same asymmetrical risk-reward setup.
Right. They see the 0.00, they see the 449.89 support, and they step in to buy the heavily discounted liquidity. When the author synthesizes the data like this, the reader is armed with a strategy, not just a statistic.
But, you can set the tightest stop loss in the world on lucky cement, and if the broader KSE-100 index suddenly collapses, that micro-strategy is entirely useless.
Oh, completely.
Which actually brings up a structural disconnect in how this text is organized. The current breakdown isolates the KSE-100 index performance from the sector-specific movements, leaving a critical divergence between macroeconomic momentum and micro-level setups entirely unaddressed.
Yeah, the author, they bury a fascinating contradiction in their own data here.
What do you mean?
Well, the weakness is that they point out the KSE-100 index closed down 1,463.60 points. That is a steep 0.81% drop in a single session.
Right, a massive drop.
Yet its stochastic RSI on the 4-hour chart is floating right in the mid-range at 46.63.
Wait, really? The broad index is hovering near 46, but you just said luck is literally at 0.
Yes, and Pakistan Telecommunication, PTC, is at 9.65. DGKC is at 18.80.
Oh, wow. So they are totally bottomed out.
Heavily oversold, completely bottomed out. But that mid-range 46.63 reading on the overarching index indicates the broader market still has significant room for further bearish momentum before it hits its own systemic oversold threshold.
So they're treating them like they exist in different universes.
Exactly. The material treats the KSE-100 and these individual scripts in silos. It completely fails to reconcile the glaring tension between a macro index that has room to fall and micro assets that have already hit rock bottom.
The macro has room to bleed, but the micro is theoretically out of sellers. So what is the suggestion to fix this divergence?
The author needs to actively weave the index's mid-range momentum into the analysis of the individual stocks. They have to create a holistic, interconnected market narrative.
You have to weigh macro systemic risk against micro technical support, right?
Precisely. For instance, when discussing taking an early bounce position on PTC at its 70.41 support level, the text must explicitly weigh the systemic risk that the KSE-100 index, which is sitting at 179,846.68, still has considerable room to drop.
So that warns the trader that PTC support might easily break simply due to the gravity of the broader market.
Right, regardless of how oversold the individual stock is on its own.
Let me push back on how we are interpreting this data divergence, though.
Okay.
I hear you on the systemic risk pulling things down, but look at the math of the index itself. If the KSE-100 isn't oversold, but all the major cement and telecom scripts we're analyzing are deeply oversold, doesn't this imply there is a phantom sector, maybe banking or fertilizer, artificially holding the index up? Should the material be actively hunting for that missing weight instead of just treating the divergence as a risk factor?
Oh, absolutely. If you don't hunt for that missing weight, you're flying blind to sector rotation. The KSE-100 is a cap-weighted index.
Right.
So if heavyweights in cement and telecom are scraping the absolute bottom, but the index is sitting comfortably near a 46 reading, capital hasn't left the market entirely. It has just rotated into a different sector that is propping the entire structure up.
And the analysis leaves the reader completely unaware of this vulnerability. Because if that unmentioned strong sector finally cracks and starts taking profit, the index drops.
And it will drag those already oversold cement stocks right through their support floors. A 0.00 stochastic RSI can stay at 0.00 for weeks during a systemic liquidation. The oscillator doesn't magically print buyers.
Right. It just means momentum is stalled at the bottom.
Exactly. Contrastingly, the author could weave this interconnected narrative by highlighting a stock like TPL Corp.
How so?
While it is showing technical strength with a Stoch RSI of 75.05 within its ascending channel, that relative strength is notable precisely because it is actively defying the broader market's 0.81% daily decline.
Right, that divergence is the actual story.
Yeah, but it gets lost because the micro and macro are kept entirely separate.
Hunting for that phantom sector requires a stable lens, which actually brings us to another structural friction in the actual technical tools being deployed here.
Yeah, the timeframes. The report shifts technical timeframes abruptly in comparative sections without addressing how these distinct perspectives impact the overall trading narrative.
Yeah, it felt very disjointed. What was the specific weakness you found in that section?
It fundamentally breaks the baseline of the analysis. So throughout the review of the KSE-100, DGKC, LUC, and PTC, the author relies heavily on a 4-hour chart.
Which is pretty standard.
Right, it establishes a specific macro trend rhythm for the reader. We are looking at half-day blocks of price action. But then, when the text moves to comparing DGKC and Jandora Industries, GHNI, it suddenly analyzes GHNI using a 1-hour chart, calling out an oversold stochastic RSI of 5.42.
Jumping from a 4-hour to a 1-hour chart without warning is jarring. It is like looking at the forest with binoculars and suddenly switching to a magnifying glass for one tree.
That is a great analogy. The reader completely loses their sense of scale and orientation.
Yeah, you just lose the context.
Exactly. Comparing a 4-hour macro trend indicator directly against a 1-hour micro trend indicator skews the entire comparative analysis.
Because they move at totally different speeds, right?
Right. A 1-hour oscillator can read oversold simply due to a brief burst of intraday selling or a minor news event, while the 4-hour chart remains firmly bearish with plenty of room to fall. They are measuring entirely different cycles of volatility.
So running a side-by-side comparison of a 4-hour trend and a 1-hour trend without reconciling the two is just analytically invalid.
Yeah, and it introduces severe technical whiplash for the reader.
So how do they fix the structural layout to prevent this whiplash? What is the suggestion?
Standardize the primary time frame across all baseline comparisons. If a shift to a shorter or longer time frame is tactically necessary, to pinpoint an entry or highlight a microtrend, the author must explicitly justify that pivot to the reader.
Give me an example of how they could write that justification.
Sure. So in the section titled Technical Indicators for DSKC and GHNI, explicitly state that GHNI's 5.42 oversold condition is a highly volatile, short-term microtrend.
Okay.
And contrast that by reminding the reader that DGKC's 18.80 reading represents a much more foundational 4-hour macro trend development.
What about running dual time frames simultaneously so the reader can see both cycles? Does that work?
That works exceptionally well, actually. You provide a dual time frame view for GHNI to bridge the gap.
How would you phrase it?
Write something like, while the 1-hour chart shows extreme oversold conditions at 5.42, traders must align this microtrend with the broader 4-hour resistance before confirming a safe entry at the 1,242.50 level.
Ah, that tells the reader exactly why you are looking at the 1-hour chart, but it anchors it back to the established 4-hour baseline.
Exactly.
Oh, definitely. Taking that a step further, institutional trading algorithms are entirely built on top-down time frame alignment. They do not execute off a 1-hour chart in a vacuum.
Right.
Implementing a strict top-down formatting rule wouldn't just solve the reading friction, it fundamentally upgrades the professional utility of the document.
Because it frames the whole narrative.
Right. When you start with the daily, you establish the overarching primary trend. The 4-hour provides the intermediate momentum. The 1-hour offers the tactical execution trigger.
It forces the writer to reconcile the micro with the macro on every single asset they cover.
And it automatically builds in that missing strategic synthesis we discussed earlier. If the daily trend is heavily bearish, but the 1-hour is showing oversold at 5.42, the top-down format forces the author to immediately recognize the context.
Right. They have to state, this is a counter-trend scalp, not a long-term bottom.
Exactly. It prevents the analyst from getting tunnel vision on a single time frame and keeps the overarching strategy intact.
Well, let's synthesize exactly what we've covered today to give the listener a clear path forward.
Sounds good.
First, this document needs to evolve raw data points into actionable strategies. Don't just list extreme stochastic RSI readings. Provide the so what by explicitly outlining risk-reward ratios, like defining tight stop losses for luck right at that 449.89 channel support.
Right, exactly.
Second, bridge the narrative gap between the KSE-100's bearish mid-range momentum and the oversold extremes of the individual scripts. Don't let them exist in silos. Weigh the micro setups against macro systemic gravity and actively look for the hidden sectors propping the index up. Finally, maintain comparative integrity by standardizing your chart timeframes. Or, if you are going to introduce a 1-hour micro view against a 4-hour macro view, explicitly define why that pivot is happening so the reader's perspective remains perfectly calibrated.
You know, the foundational data collection and technical groundwork in this material is highly accurate, and precisely mapping out these support zones is often the most difficult hurdle in market analysis.
Oh, absolutely. The data is solid.
It really is. So I highly encourage the listener to implement these structural and analytical tweaks to pull that solid data together into a cohesive strategy. We would love to see how this evolves, so please submit your revised market analysis back in for a future critique.
Ultimately, a dashboard full of perfectly calibrated dials is a beautiful piece of engineering, but is only valuable if you know how to navigate the terrain outside the windshield. Turn those precise instrument readings into a strategic roadmap, and the true impact of this analysis will become undeniable.